Welcome to Stock Informer for you. The noise in the market is loud, but we prefer to let the data do the talking. Is the Indian IT party officially over, or is this just the calm before the AI storm? Tata Consultancy Services just dropped its Q1 Fiscal 2026 earnings report. On the surface, the numbers look steady. But as an elite equity research analyst, I don't look at the surface. I look at the structural cracks underneath. Right now, tech companies are fighting a multi-front war, a global freeze on discretionary enterprise spending, vendor consolidation, and a massive 2 to 3% pricing deflation in legacy contracts driven by GenAI. Oh, and there's a fresh multi-crore legal penalty thrown into the mix this quarter. In this video, we are going to do something the mainstream media won't do. We're subjecting this IT giant to a brutal 10-point worst-case stress test to find out what this stock is actually worth if macro conditions turn upside down. Let's dive into the raw data. Baseline performance analysis. Let's look at the baseline performance first. For Q1 ended June 30th, 2026, the company posted a revenue from operations of 72,275 crore rupees. Sequentially, that's a small step up, showing that their massive execution engine is still grinding along. But look closer at the margins. The EBITDA came in at 18,556 crore rupees, giving us a healthy EBITDA margin of 25.67%. However, after accounting for depreciation and a spike in unallocable corporate expenses, the EBIT, or core operating income, landed at 16,376 crore rupees. That pushes the operating margin down to 22.66%. Why the squeeze? Corporate overheads are rising, and the macro reality of 2026 means clients are squeezing vendor rates. Now let's talk about the bottom line. Net profit stood at 13,420 crore rupees, resulting in a quarterly EPS of 36.90 rupees. But remember, this net profit includes a heavy punch to the jaw. A 668 crore rupees exceptional legal settlement fee paid to Computer Sciences Corporation after the US Supreme Court denied their final petition. With the stock trading at a last traded price of around 2,069 rupees, the market is pricing this under a normal scenario. In a normal next quarter, assuming a modest 1.5% sequential recovery and zero exceptional legal drama, we'd project revenues of 73,360 crore rupees and an EPS recovery to 38.50 rupees. But what happens if everything goes wrong at the same time? The 10-point structural stress test. Welcome to the ultimate IT stress test. We simulated a synchronized worst-case economic shock for the upcoming quarters. Here is how the business model holds up across 10 critical vulnerabilities. Point 1. GenAI revenue deflation. As clients use autonomous AI agents to automate basic maintenance, legacy FTE build contracts face a sharp 5% contraction. Impact, a 1,445 crore rupees top-line hit. Point 2, discretionary spending freeze. Global enterprises abruptly halt or cancel 15% of their digital consulting and transformation pipelines to protect cash. Impact, a 2,168 crore rupees revenue reduction. Point 3, slower deal-to-revenue conversion. High total contract value deals are signed, but clients stall execution, lagging revenue recognition by 45 days. Impact, a quarterly revenue lag of 1,000 crore rupees. Point 4, pricing power compression. In vendor consolidation brawls, clients demand an aggressive 4% mandatory discount to renew long-term contracts. Impact, another 1,445 crore rupees shaved off revenue. Point 5, geopolitical and visa restrictions. Tighter immigration rules in the US and EU force the company to hire expensive local subcontractors. Impact, delivery costs jump by 850 crore rupees. Point 6, currency volatility. Unfavorable cross-currency shifts, specifically a weakening euro and pound against the rupee, bite into export realization. Impact, shaves off 360 crore rupees. Point 7, key client concentration shock. A coordinated 15% spending scale back across the elite top 5 banking and manufacturing accounts. Impact, a direct loss of 1,084 crore rupees. Point 8, Bench cost and utilization drag. A skill mismatch leaves a portion of the workforce trained in legacy technologies undeployed. Utilization drops to 72%. Impact. Fixed salary drag increases costs by 700 crore rupees. Point 9. Cybersecurity and system disruptions. A simulated system breach occurs, causing minor operational delays, legal compliance costs, and remediation. Impact. A 650 crore rupees hit to operations. Point 10. Wage inflation for premium tech talent. While legacy IT wages stall, the cost to retain elite talent in agentic AI, cloud cyber defense, and advanced engineering continues to skyrocket. Impact. Compensation costs rise by 900 crore rupees. When you stack all these synchronized shocks together, the fairy tale ends. Our stressed revenue projection drops heavily to 65,773 crore rupees, and operating margins get crushed down to 16.50%. Under this extreme stress, quarterly EPS plummets from 36.90 rupees down to just 23.10 rupees. Price discovery and valuation. So, what does this mean for the stock price? Let's do some serious price discovery. In a normal scenario, where the company prints an annualized EPS of 154 rupees, applying a standard valuation, multiple makes the current market price look like a reasonable entry point. But in our stressed scenario, the annualized EPS falls to 92 rupees and 40 paise. Because structural growth is severely impaired in this scenario, the market will derate the stock, compressing the PE multiple down to 12.0 times. When you multiply a stressed EPS of 92 rupees and 40 paise by a compressed 12 times multiple, the discovered fair value of the stock falls to 1,108 rupees and 80 paise. Look at the comparison on your screen right now. The current last traded price sits at roughly 2,069 rupees. That means the market is pricing this asset as if it is completely immune to macro decay. Relative to our worst-case boundary of 1,108 rupees and 80 paise, the stock is technically overvalued by over 86%. This highlights exactly why having a structural margin of safety is vital when investing in large-cap IT. Conference call. Insights and qualitative analysis. Now, numbers only tell half the story. Let's look at what management admitted behind closed doors during the earnings conference call. First, on future guidance, the leadership team is banking heavily on a gradual demand stabilization in the BFSI sector, which currently remains their largest revenue anchor at 27,990 crore rupees. They are leaning heavily on mega cost optimization deals to keep the pipeline alive. Second, regarding management admissions and negative discussion, there's no hiding the margin pain points. Unallocable corporate expenses heavily weighed down profits this quarter. On the bright side, the definitive closing of the CSC legal dispute removes a massive dark cloud over the company, despite costing them an extra 668 crore rupees exceptional cash charge this period. Third, looking at their growth plans and AI strategy, they aren't just talking about AI, they are deploying it. Scaled AI frameworks and cloud architectures are actively expanding into life sciences and consumer segments to optimize operations for clients. Finally, under capital allocation, management proved they are committed to shareholder returns, declaring an interim dividend of 12 rupees per share while keeping attrition stable by flexibly shifting talent across delivery verticals. The baseline engine is highly resilient, but the valuation leaves very little margin for error if macro shocks or GenAI deflation hit harder than expected. Drop your thoughts in the comments below. Is Indian IT a defensive buy right now, or is it a value trap? Thanks for watching, and I'll see you in the next deep dive.